I'm Alan Kenny here at REITs REIT World. I'm joined by John Pawlowski, analyst with Green Street Advisors. So, John, earnings season for the single-family residential REITs is wrapped up. What were some of the key takeaways for you?
Yeah, on the operating front, I'd say third quarter earnings were a bit disappointing for the single-family rental REITs. We saw outsized revenue growth deceleration from what we had expected going into the quarter, both on a slight dip in occupancy and a little softer rent growth than our expectations. Growth still is quite favorable versus apartment REIT revenue growth. So the single-family rental REITs printed on average roughly 3.5% same-store revenue growth. That compares to apartment REIT revenue growth of 2.5%. So favorable on a relative basis, but versus our perhaps elevated expectations, top line growth wasn't as strong as we expected. On the expense side, expense and cost control was a silver lining. The REITs on average expanded their core operating margins by 175 bips, which is quite compelling. Property taxes, repair and maintenances, and property management costs are all sourced for the upside, and they're doing a great job of controlling costs across their platform.
And the total returns in this sector have had a pretty good run for the last 2 years.
Sure.
What kind of risks and opportunities do you see going forward for the sector?
Yeah, they have had a great run, in large part due to operations. So I expect investor focus to remain on the operations story. So on the opportunity side, expenses are still an opportunity. They're still early innings of cutting costs out of their platforms, whether it be the property management side, less headcount, managing greater amount of homes. Or on the repair and maintenance side, controlling vendor costs and maintenance costs. There's still fruit to pick there. And on the revenue side, on the opportunities, ancillary income initiatives will be explored and can be exploited next year and the year after. Still early innings there. That said, those opportunities do become risks if they don't execute on those given expectations. So if cost control suddenly looks more transitory by nature, and you see some cost upticks in 2018, if CapEx levels start to rise, it could spook investors. And then if rent growth, I mentioned this slight concerns in third quarter. If rent growth starts looking a lot like apartment rent growth, I think it's going to be a negative surprise for the stocks in the near term.
And lastly, the big story this year in the sector has been the Invitation Homes merger. How's that affected the outlook for the sector?
Yeah, I think all in all, I think it's positive for the sector. It's certainly been a positive for both Invitation and Starwood Waypoint shareholders. They're now have inherited a better company, a bigger, more efficient, better management team as a combined entity versus two separate entities. They're both capable as standalone firms, but now they're stronger. So the sector has a bigger company, it'll be a top 20 REIT, potentially hits the S&P 500 over the near term. So you're staring at a company that's better positioned as a consolidator in the sector today versus what they were as prior entities. So you're left with two large-scale, high-quality operators that can consolidate the space and capitalize on some of the near-term opportunities.
Well, thank you so much for your time, John.
Yeah, thanks for having me, Alan.
For more on this and other real estate news and analysis, be sure to visit NAREIT's website, REIT.com.